I think that a recession in Germany, I tend to agree, is looking highly likely now. So, yes, I think that with the energy situation that we're facing, I think we're hearing more and more commentators from Germany expecting that. So, it's something that we've been fearing for a number of months. It's certainly been sort of in the Putin playbook to be able to threaten Europe in this way, and I don't think it's certain that the gas stays switched off permanently, but it's certainly there in a set of the games that he can play.
Can I ask you, specifically, what does this mean, do you think, for your industry here? Because we have seen a number of energy companies go to their governments cap in hand for support. There will be concerns about some weak hands in the energy sector, not only in Europe, but in the United States. How concerned or otherwise are you about defaults rising in this particular space?
Yeah, well, I think that sort of when you say our industry, then obviously we start to think about credit losses and defaults. And so it's then sort of which industries are going to get the biggest problems from that and what's going to suffer most. I mean, clearly we're concerned about consumer industries and sort of consumer discretionary as we go into the cost of living crisis, and as sort of consumers suffer from bigger energy bills, what's that going to do to their spending and their spending habits? So we're more concerned about sort of second order, third order effects as to how this all plays out. And so then obviously we start to look at sort of what is it that governments can do. But certainly for lower income groups, the cost of living crisis is something that we're concerned about. I mean, when it comes to defaults, companies have come into this with reasonably strong balance sheets. They've had decent free cash flow. And so as a starting point, companies are in a good place. But clearly there are certain industries that will go under far greater economic shock than others. And obviously we're seeing some oil and gas names with sort of supernormal profits through to other sort of industries, particularly sort of consumer discretionary, that we're expecting will face much tougher times. And I think that your former guest was sort of saying that the actual sort of cost of living crisis is still on its way. So we're seeing sort of higher prices in the wholesale markets, but that's not necessarily fed through yet to the consumer.
Jonathan, all very interesting points. I'm interested in your comments we've got here about the CLOs, the collateralized loan obligation market as well. My question is there a bit of a buyer's strike for those loans at the moment? We're hearing about funds pulling capital out of the area. But two, you make the point about, well, we'll see more issuance when arbitrage is clearer. Just answer both points, if you would.
Yeah, so, I mean, there's an alleged buyer's strike in loans. I don't think there is, but for new issue to work, it needs to come at some level of concession to cause an investment manager to want to sell his existing positions and buy the new issue. And so I think the challenge for banks bringing loans or bonds to market is obviously they need to be attractive relative to what's out there. So the relative value needs to make sense. And I think that's what's clogging up the new issue pipeline. And obviously there's a lack of confidence. I mean, when it comes to CLOs work where you have an equity investor who believes that their returns will be attractive. And where we've seen the cost of debt of a CLO widening pretty consistently through the year, you either need the asset prices to fall or the cost of that debt to come down again for that arbitrage to be strong. And so that's what's challenging in the market right now. So we've seen the AAA debt widen from, in round numbers, call it 100 over to 200 over the course of the year. And obviously that has to translate through into the asset prices if those CLOs are going to look interesting.